Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com.
Greetings and welcome, Vania. It's fantastic to have you on the podcast show.
Thank you so much for having me. It's a pleasure to be here.
Now, before we start the meat of our conversation, I do like to ask my guests something about their background. So it would be great to know something about your origin story. What did you study at university, and was it inevitable you'd end up in academia?
So thank you for this question. So I grew up in Bulgaria. I'm originally from Bulgaria, and I'm the last generation that lived through communism, and as a result, through all the crises following communism, hyperinflation, sovereign debt crisis, banking crisis, which is why I was interested in economics. So when I went into college, it was pretty clear for me that I wanted to study economics, particularly international finance. I also studied math, as every diligent Eastern European is advised to study, which thankfully I did. And then I spent 2 years at the Brookings Institute, followed by my PhD at Harvard.
Great, fantastic. And I see that in recent years, you've done a lot of work on currency markets, foreign exchange. Why currencies rather than any other market?
So exchange rates was always a passion of mine. Actually, my first FX paper was after undergrad when I met Ken Rogoff at Brookings, and we wrote a paper on unsampled exchange rate forecasting. And of course, exchange rate is one of the most interesting and important prices in international finance, right? So, and it's one of the least understood prices in financial markets, which is, I like a challenge, which is why I studied it. So indeed, I have studied exchange rates from various angles throughout my career, and I have a number of papers on it. If you would like me, I can just give you a brief overview of what are the different ways to think about FX determination, and I'm going to bring my research throughout the discussion.
Yeah, maybe we could frame it. You mentioned Ken Rogoff, and he, of course, wrote that famous paper in the early 80s by Dick Macy and Ken Rogoff on our inability to forecast currencies. And you know, so...
Yes, so actually, the famous paper that they wrote in 83 with Dick Macy generated a whole literature trying to not just show that exchange rates are forecastable out of sample, which has been incredibly hard, but also in sample, it was shown for many years that one can't find a connect between exchange rates and pretty much almost any variables. So the good news is that the in-sample reconnect has been shown to exist now, and actually my work has contributed towards that, particularly with macroeconomic surprises, and I can tell you a bit more about that. Of course, out-of-sample forecasting remains challenging, and I'm exploring it in ongoing work of mine based on the papers that I've written, and I'm happy to tell you more about it as well if you're interested.
Yeah, great. Okay, so let's go back to what you were saying earlier about the determinants of exchange rates.
Yeah, so there are two ways to think about exchange rate determination. So essentially, one of the standard ways is to take what's called the no arbitrage condition in our finance models, which we call also the Euler equation, right? And then you can express any asset price, including exchange rates, as a function of forward-looking variables. So what do I mean by this? You can show that the exchange rate can be exchanged over any two periods, can be expressed as the interest rate differential in period T, if you're studying the T plus to T plus 1 change, for example, into currency risk premium as of period T, and forward-looking components that capture the revisions in expectations over the relative nominal policy rate paths, revisions in expectations over the relative nominal, essentially inflation rate paths across the two countries, and revisions in expectations over the currency risk premium. So in my research with Jenny Tang at the Boston Fed, we show essentially constructing the subcomponents of this decomposition. To do that, we actually use survey data in order to back out the whole expected path of inflation expectations, interest rate expectations, and exchange rate expectations. We show that the forward-looking components, not surprisingly, are the main driver of exchange rates, and particularly...
And on the data, where do you get this survey data?
So we use consensus economics, blue chips data. You can effectively use various survey data, and the approach, the methodology that we use is essentially you take your standard way to construct expectations of variables, which would be you run some kind of vector autoregressive essentially process. But then instead of just stopping there, you are disciplining the expectations produced by this model using survey data, right? So the idea is that we know that running a simple VAR is going to generate massive downward bias and very flat expectations 2 years ahead. So, for example, if you're familiar with the Campbell-Shiller decompositions, which is a similar decomposition for stocks, for those researchers that back in the day that would use a simple VAR to get the expectations going forward, they realized that's garbage, right? So the literature moved away from this kind of simple VAR-based approach. And one of the ways to remedy this problem is to discipline the expectations using survey data, which has been done in the fixed income space, for example, to decompose yields into expectation, hypothesis, and term premium. We were the first to do it for FX. So we have a
and
series.
Just for our audience, when you say VAR, you mean a vector autoregression functions as an econometric.
Yeah. So for example, how do you get
risk.
expectations? You usually run a VAR, but most people are going to end there, right? So what we say is you're going to get a massively biased forecast by running a simple VAR, unless you use some econometric techniques to address the small sample bias. But an even better way is to say, well, actually, if we believe that the survey data captures fairly well the expectations of the market, there is pricing currently asset prices, right? So whatever expectations they have factors in the trading decisions, etc., then expectations, right, as a measure of what are the market expectations. And that's what we do. So we augment the VAR approach so that the VAR-based expectations are fairly close to the survey-based expectations. So that's kind of the methodology of the procedure. So using that procedure, you see that it is the currency risk premium, right? That's kind of the main driver. So then when I told you that now we have a reconnect between macro variables, you might wonder, okay, usually currency risk premium is perceived to be driven by stuff like risk aversion and VIX, right? TED spreads. And we have shown, to a large degree, connection these days between exchange rates and this kind of more financial variables, if we wish, that measure market sentiment, risk aversion, liquidity issues in financial markets, etc. CAP deviations being another important variable. Now, what we show in our work that, yes, it is the case that this forward-looking currency risk premium component is the main driver of the FX. But actually, it turns out that currency risk premium is to a large degree driven by the same macro news that are linked to inflation surprises. And what I mean by surprises is realization of inflation, CPI inflation, minus, let's say, expectations prior to the release of the CPI.
So macro surprises, you're saying, drive risk premium as much
risk
as
premium and
VIX
exchange
and these other
rate.
factors.
Yes, that's how you can think about it, right? So why is it the case? The model that tends to explain not just FX, but we've applied it also to stock markets in some of our work, is risk aversion is very tightly linked to macro fundamentals. So your risk on period can be explained, actually the global financial cycle and your risk on period, actually in some of my latest work, we show that can be linked to US-centered macro news in particular, right? Both contemporaneous and like macro news, not just contemporaneous.
And the macro news, the news surprises, I mean, has that become more important in recent years, or has it always been, a factor that drives risk premium?
So that's a very good question. So sensitivity to macro news clearly has been always there, right? I mean, you turn on Bloomberg and they discuss whatever macro release there is on that day, but the sensitivity varies over time. So some of our research actually points in the direction of when we would expect macro news to matter. So we find that macro news matter more during periods of high uncertainty, right? So that's when markets are learning more through what we call public signals or common signals, right? So you're essentially pretty much putting a larger weight on macro signals. So high uncertainty recessions, these are periods where macro news tend to matter more. Now we also find in our work that it's lagged macro news rather than contemporaneous. So that's truly the novel contribution of a lot of my research, is to focus on lag rather than contemporaneous news. So that's something that was missed in the literature for a long time. So the reason why massively connects to FX, for example, we find that lagged macro news account in sample, that's not our sample, for about 50 to 60% of the fluctuations of exchange rates at monthly and quarterly frequency, is because actually it is lagged rather than contemporaneous news. So the reason why often both the academic research, but often also financial practitioners focus on contemporaneous, is because they say, oh, lagged information is priced in. But that's not necessarily the right way to think about it, because at every single point of time, markets are learning about the state of the economy. So let me give you a concrete example. So imagine you have CPI released today, and then you find that the inflation number was higher than the consensus, right? So you have a positive surprise. In order for you to interpret what the impact of this positive surprise will be on any asset price, doesn't have to be FX, it has to be stocks, fixed income. You need to take it in context to what was the latest GDP release, right? And what was the latest GDP surprise or non-farm payroll. So why am I saying that? Well, for example, if we live in a world where we have a positive CPI surprise today, But then in the last quarter, we had a negative GDP surprise. Markets are extrapolating based on this information that we probably live in a supply rather than demand regime, right? So you're using today's release in context to previous releases to figure out, is the variance of supply shocks bigger than demand shocks, right? Is the shock persistent or not? So we're constantly learning, right? So in economics, formally, you're going to write a Bayesian updating model to do that, but the model is so complex that clearly no financial market participant is kind of solving any model, but they're doing it in the back of their head, right? They're trying to figure out, okay, what does this surprise mean in the context of kind of the latest news or the history of news? So the moment you start learning about what we call second order moments, not just the mean of supply and demand, right, but also the variance, persistence, then the lags matter, right? Because you're putting a weight on the lag surprises. In a sense, that's what kind of the model generates. And that is one of the justifications why lags is so important. Now, the question arises, can you make money out of it, right? So the answer is that to the extent that the interpretation, effectively you're changing the interpretation of the lag surprises, if you wish, because you decide that now we're in a supply rather than demand regime, right? Now, in order for you to make money out of it, granted that the interpretation changes due to the new information that arrives today, right? Is the interaction of the two. You need essentially markets not to be good at optimally updating their beliefs, right? So they need to be rational in some way, which clearly is the case. No one can solve these complicated Bayesian models. Actually, it's hard for us to solve it. We need to use some tricks to do it in our research. So granted that markets are not doing the optimal Bayesian updating, yes, you can exploit that in order to effectively develop forecasting models based on this lag macro news, which I have started doing.
So there is some hope then in terms of finding.
Yes, I've started exploiting that.
And is the workhorse of this rate differentials, the carry trades, is that the engine one would look at, because you're looking at uncovered interest rate parity, carry trades.
Differentials definitely play a role, and usually people think about interest rate differential from the fixed income market, right? In the sense that you have that, for example, the interest rate in the US increases relative to Europe, and then people are doing the carry trade, they borrow in Europe, now the carry trade becomes more profitable, you borrow in Europe, you invest in the US, you put market pressure in the door from the fixed income market. So that's about the second way to think about FX determination coming from positioning of holdings, which I wanted to talk about, right? I think about it a little bit separately. Clearly, the two equations have to hold. Your no arbitrage conditions, where is this going to show up? It's going to show up as a link between the currency risk premium and interest rate differential, which of course has been shown to exist, right? So you need to find the same relationship between exchange rates and interest rate differential. But the more intuitive way to think about this for me, the carry trade in particular, is by thinking about these positioning models, right? And how market pressure due to changing the positioning with respect to dollars coming from the fixed income market is putting an upward pressure on the dollar, for example.
Okay, so in terms of that positioning then, let's delve a bit more deeply into that.
So the second part of my research agenda focuses on effectively how do we think about holdings and positioning, if you wish, in financial markets as drivers of asset prices. There I developed a completely novel decomposition, which actually first I developed it with the goal of studying FX, but it just so happens that it works beautifully for equities as well. So now I have a lot of research on equities as well. But the idea there is actually, let me start a little bit with a brief description on, you have to explain how it works for equities in order to be able to explain how it works for FX. And there is also a mapping to fixed income as well. But the idea there is you take your, what we call market theory and condition, nominal supply has to equal nominal holdings, right? Or nominal demand. So in a market-based economy, this has to hold. If you observe the universe of holdings of a particular stock, let's take in this case Apple, a given ISIN for Apple, then if you have the universe of holdings for Apple, this has to add up to nominal supply. What is nominal supply? It's the price of Apple times the shares issued, right? Now, the shares issued at an ISIN level is pretty much driven by buybacks, and it doesn't explain much of the variance, if you wish, of the price itself. It's not a very volatile variable. So the nominal supply is just, the change in the nominal supply is just the change in the price of Apple, which is kind of what we're trying to explain. So that's what you have on the left-hand side. What do you have on the right-hand side? Well, we have the change in holdings, which are summed up across every single investor that buys Apple. So this would be from hedge funds to pension funds to mutual funds, etc. Right? Now, you can decompose this change of holdings. So what I show by developing this novel decomposition is that this change of holdings can be broken down into components with very intuitive interpretation that then later can lead you into the direction of thinking about causality and how do we develop investment strategy etc. Right? So what are those components? The price of Apple can be moving because of rebalancing, right? Portfolio weight changes. So this was one of the components of the change in holdings. The second component is the growth rate of assets in the management. So imagine a given fund now increases their assets in the management. On average, they're long Apple. And then, of course, this is going to also put upward pressure for Apple. The most mechanical thing being index funds, right? Money is flowing into index funds, which is putting an upward pressure on Apple. The growth rate of assets in the management can be further broken down into the net of fee returns component. So essentially, you make profits on your portfolio that get reinvested, including in Apple, right? Or final inflows and outflows into the fund. So those are the two components that indeed have very intuitive interpretation. And there is a fourth subcomponent of holdings, which is exchange rate valuation effects. That's where the exchange rate is going to enter the story. And it captures that you have US dollar funds, let's say, buying Brazilian stocks, and they need to exchange the currency in between, putting upward pressure potential on the currency. Now, if you have all the holdings, you can construct those components, and then you can test various theories and kind of discuss what are the drivers of equities, etc. So the revelation that I had in my research is actually, even if we focus only on mutual funds, where we have the best data, right? We also have very good data coming from the US using, let's say, SEC 13F, also, not just mutual funds, but hedge funds, essentially everyone that holds equity. It's a bit trickier to use that data to the decompositions because you don't necessarily see the final inflows and the net fee returns, which you see in the mutual funds, right? So there are the regulatory forum and also companies like Morningstar.
And the mutual funds you just get from some database that provides these sorts of things.
It's Morningstar. So we use Morningstar Direct, which reports essentially the variables that you need in order to construct the subcomponents of the decompositions. And the paper Elephants in Equity Markets kind of discusses in detail how we do this, the construction of these components. So the revelation is the following, right? So you have a limited coverage. For the US, we have 15% of the coverage, right? So what do you mean by coverage? Holdings relative to the market cap of a particular ISIN. If you go to other countries, we have 33 countries and 20,000 stocks, right? ISIN. So it is a global model. You have even more limited coverage. For China, we have 0.01% often. So the idea here is that, well, even with this limited coverage, and even if we observe only mutual funds, and again, here we focus only on a sample starting 2008, which is the period when mutual funds grew in importance, right? So you're not going to get as much of a good fit if you kind of do it in the 90s, of course, when the asset management industry wasn't so prominent in the equity space. So starting in 2008, the observations I had is like, well, wait a second, we might have limited coverage, but if the mutual funds are representative of the behavior of the investors we don't observe, then you can take their holdings and scale them up as if you have a representative sample. So what do I mean by this? So the good news is that we observe the pension funds and insurers' behavior through mutual funds because often mutual funds are going to issue a share class to accommodate pension funds investment, right? So you kind of have also those big players indirectly in that data, if you wish. And the idea is you're going to split your funds by type. What do you mean by type? So let's take large caps, US stocks, active funds, certain frequency of rebalancing. So you can have very granular bucket, especially for the large stocks. When you go to a small stocks, you don't have that many funds, so you can't go that granular. But for Apple, you can go really granular. And then what you do is say, well, let's take each component. Let's say the portfolio weight changes, right? We can always break down for every single fund's holdings of Apple, the portfolio weight change of fund I with respect to Apple. I can decompose it as an average within this narrowly defined bucket of funds and residual, right? You can always do that simple decomposition. Now, this average that I can construct based on the sample that I observe, as long as it's fairly closely aligned with the population average for the funds that belong in that bucket, then effectively I can scale up these averages if I observe the universe of holdings. So that's the idea here. It turns out that the idiosyncratic rebalancing, which is very volatile, right? So if you look at our plots, you see a cloud of dots for the portfolio weight change, and this average of dots cancels out because someone is going to get more long into Apple, another one is going to go more short, and then this is going to cancel out. So this equity prices, if you wish, explaining between 60 to 80% of the variation across 33 stock markets. And the reason why it's the average that matters so much is because the way to think about it is this is the information that is contemporaneously priced in by the whole market, right? So we all observe the end of quarter Apple reports and we're rebalancing with respect to Apple based on that information. Now, the cloud of dots can be very valuable because maybe you have some fund manager that has an amazing model and good at forecasting the price of Apple going forward. But that information is not part of the information set of everyone trading today. So it's not going to move the price of Apple today, right? That's why contemporaneously it's going to be this portfolio weight change. Now you do that for the flows and the net of fee return subcomponents, you scale it up. And now it turns out that across 33 stock markets and 20,000 ISINs, contemporaneously, you can account for about 90% of the variation of these 20,000 stock prices at monthly frequency, right?
You said 90.
90.
Okay.
Yes, it's striking. I've tried to kill it. Essentially, now when I present this evidence, I have to go and show China and a stock with a 0.01% coverage and show when it doesn't work, right? Because no one, I mean, I can show you some plots, but I don't think we have the time. But the fit is truly striking, especially for the big ISINs, the fit is perfect, right? And again, the idea is these guys are representative, right? Now, we're going to move into exchange rates, but before...
And just one thing about the variation. Presumably the Morningstar data, all this flow data comes with a lag. Is it point in time data you're looking at,
Yes.
or are you looking at...
contemporaneous decomposition, and the way I have used it in order to develop investment strategies based on that, right? Because the contemporaneous relationship is not what you're going to use in order to kind of develop investment strategies, is to essentially exploit the heterogeneity in objectives among the different players in the markets. What do I mean by this, right? You have some set of funds that are going to be contrarian, some are going to be momentum. You have the index funds versus active. So by playing the heterogeneity in objectives, you can exploit lagged information in these components. And I have developed strategies with a Sharpe ratio of 20% return, market neutral, based on this components. That is not going to be made publicly available, but it is possible to use the subcomponents. And again, the idea is, I mean, to give you an example that probably most of your viewers are going to be familiar with coming from the fixed income space, right? So how do people exploit the heterogeneity in objectives and preferences there? Clearly, when the central banks are doing Q and QT, investors are front running, for example, the purchase of the actual long-term government bonds. You're exploiting the presence of pension funds that have, liability-driven investment, and they're going to hedge. So this has been exploited massively in the fixed income space. This is equivalent in the equity space, right?
Okay.
Because you do have a lot of heterogeneity. You have guys that are doing fundamental analysis. You have the index funds. You have guys that are momentum, reversal, etc. And that's how you can exploit. That's truly positioning from the equity space, right? If you wish. And then the papers, for those of you that might be interested in kind of stylized facts coming from this decomposition, because then you can take the decomposition and ask the question, okay, which one of the components drive asset prices, right? So if you take ISIN level asset prices, indeed we find that it's the portfolio weight changes that are the main driver of essentially individual level asset prices. But when you go to the stock market level, right, the S&P versus, European indices, etc., across 33 stock markets, the picture changes dramatically. So what happens is all of a sudden for S&P, right, or for the US stock market, the main driver is no longer the portfolio weight changes. It's actually the net of fee returns and the final inflows. The final inflows account for a small fraction of the variation. Is the net of fee returns that drive most of the variation, but they're always significant. So the world that we live in for the US stock market is you're in a risk-on period, money are fleeing fixed income funds, going into equity markets, which gets amplified by the profits generated by equity funds that invest in the S&P, right? So this is the main driver.
So this is the growth of the AUM side of things is driving the index.
Indeed, the growth of the AUM, but the original shock, the exogenous shock, comes from the final inflows into the funds because the net of returns is just a function of prices itself, right? So it has an amplification effect, if you wish. Where is the original source of variation in that model? It's going to be from the final inflows into the funds and whatever the active guys are doing with the portfolio weight changes, right? They can be trading on fundamental news, etc. The rest you can map to prices and you can kind of solve it out once you write the structural model. So, but then when you go to Brazil, Turkey, even some other advanced economies, the portfolio weight changes remain an important driver, right? The net of fee returns disamplification effect is still present. The final inflows are always significant, which is good because that's where the exogenous variation comes from. But then the portfolio weight changes is still important. So then because we have the micro to macro decomposition, so that's kind of the first paper to truly go across countries and do the micro to macro, going from ISIN level to stock market, even in, in the academic financial literature, we can truly decompose why the picture changes, right? How come for the US stock market at an ISIN level, it's 60% portfolio weight changes, and all of a sudden the portfolio weight changes even slightly negative, right? The contribution when you construct the scaled covariance. So it's truly about the cross asset rebalancing. So what do I mean by this? When you go to the aggregate stock market, what changes is that it matters which stock do you buy when you sell Apple, right? So for the US, investors stayed within the dollar currency market, right? Within the US stock market. So if you buy one, they buy one US stock, they're going to sell another US stock. As a result, the portfolio weight changes, even the main driver at ISIN level, simply cancel out when we aggregate all the different stocks. Because you're not moving across. So the cross elasticities, if you wish, are negative, right? When you go to Brazil and Turkey, what happens? You sell all the stock in Brazil and you buy Turkey. So you go across currency borders, right? And that is kind of the reason
even at the
why
ISIN
the portfolio
level,
weight change.
even the ISIN level of Brazil.
Both at the ISIN and the aggregate stock market level, right? So even at the aggregate stock market level. Now you might have a question. Okay,
so just for the benefit of our audience, because
yes.
I'm just making sure that they follow this. So what you're saying is with US markets in particular, what you find is at the single company level, like the Apples and so on, is the portfolio weight changes that make all the difference. But when you aggregate up to the S&P level, what matters more is the growth in the AUM, the fund flow, the net of profit move between asset classes, like bonds to equities, equities to bonds.
Yes,
that's what drives the
essentially
index.
the final inflows into equity markets, which usually comes out of outflows from fixed income markets, that gets amplified with essentially the profits generated by the funds.
But then with EM countries like Turkey and Brazil, it's more across countries. Then suddenly the switch happens rather than within US.
Indeed, the portfolio weight changes remain an important driver.
Yeah.
Now, what about FX, right? So FX is very interesting in that space, especially when you go outside of the US stock market. So when you draw a picture, and then we have this cool network plots actually in the follow-up paper, which is on exchange rates and currency centrality, where essentially we show that the US clearly is the main player in town, more so than fixed income. So if you look at equity markets, it's US dollar funds that pretty much buy global equity markets. Right. So even if you take Europe, even if you take UK, there are significantly smaller amount of assets under management denominated in euros and pounds invested in equities. So the US is kind of the center, right? So US funds, US dollar funds are buying all global stocks. That's where the FX role comes in and the pressure into the FX markets, right? So the next thing we've done, and before I move into how do you formally map this to exchange rates, even this decompositions has implications for exchange rates due to this exchange rate valuation effect I didn't mention, right? So what does the exchange rate component do in terms of being a driver of equities? And the implications here are the same at an ISIN and aggregate stock market level. So let me discuss them at the aggregate stock market level. So we find that for every single stock market, besides the dollar, Japanese yen, Swiss franc is mixed bag, and then every currency pegged to the dollar, right? What happens is that both the currency and the stock market moves in the same direction. So what do you mean by this? When the Brazilian stock market appreciates, it's also that the real is going to appreciate, right? But that's not the case, of course, for the dollar. The usual cycle, not what is happening now, but the usual global financial cycle, now it's a US cycle. The usual global financial cycle is that all risky assets go up and then the dollar depreciates. So that's what we find. So what that means is, if you want to take your more macroeconomic hat, so as an investor, clearly you're benefiting both, if you're a US dollar investor, both from the real appreciating and the stock market appreciating in local currency if you're going to buy a Brazilian stock. What does it mean from a kind of more big picture macro point of view? It means that the fact that the exchange rate is moving, helping equilibrate equity markets, that's what it's doing, right? It's one of the many markets that the exchange rate helps equilibrate, in addition to fixed income, derivatives, real goods, is it makes sure that the volatility of the Brazilian stock market in local currency is not as high. So it dampens the volatility of the local stock market. That's why when we calculate these scaled covariances, when we do these variance covariance decompositions, and study what fraction of the S&P price movement and the Brazilian stock market price movement is due to the subcomponents, the exchange rate subcomponent contributes negatively. It dampens the volatility of the local stock market and local currency, right? Now, how do we take kind of the exchange rate component and say something more concretely about exchange rates? Because this is about, the exchange rate component is a basket of currency, right? We want to study dollar euro, dollar pound. We want to study bilateral currencies. Actually, you can do that, right? Because you have now a system of equations. I have 33 stock markets, and then the equivalent exchange rates, let's say, against the dollar that correspond to those 33 stock markets. So you have a system of equations that you can kind of flip it and solve for all the bilateral exchange rates. So now you have a model where every single bilateral exchange rate, and the interesting thing is that a lot of the things that I tell you is essentially everything applies not just to dollar base, right? So actually, particularly we study also the euro base as well. We can do it for any base. You can express any exchange rate as a function of what we call net supply components that I explain what they are, and loadings based on that, which you can think of them as elasticities, right? That are a function of the centrality of different stock markets, right? So let me just give you a concrete example. So what is this net supply measure? The net supply measure is simply the valuation of the local stock market. So that's kind of the nominal supply of equities in Brazilian real or US dollar, etc., right? So they're stock market specific, which is linked to the currency. So currency stock market specific. So the nominal supply of the stock market, which is just the price of that stock market, minus the demand for that stock market, but denominated in the investor currency, right? So granted, we said that US dollar funds own everything. That is going to be primarily US dollar investors' demand holdings denominated in US dollars. So to the extent that the nominal supply denominated in Brazilian real minus these holdings that are denominated in dollars, if there's a gap, it's the exchange rate that needs to move in order to equilibrate the market. Right?
So in that example, the net supply, so let's say from a US perspective, investing into Brazil, if the Brazilian real strengthens, then does that mean the demand has increased into Brazil?
So let me just give you even a specific example to make it a bit clearer. This is a bit complicated, I think, to grasp. But effectively, imagine that you can measure an exogenous shock, exogenous demand coming from the US, which, coming from the US for Brazilian stocks. The market can clear in two ways. One is the Brazilian stock market appreciates in local currency, right? And the second way is the Brazilian real appreciates, because if the Brazilian real appreciates, now all of a sudden the dollar demand can buy fewer Brazilian stocks, so the local stock market doesn't have to appreciate. So effectively, that's what this net supply measures is capturing, right? So by zoning into the demand denominated in US dollars, we are extracting how much the currency needs to move in order to clear. It's kind of the residual claimant. It incorporates the fact that the local stock market is to clear the market in response to this exogenous demand shock. But then if it's...
So either the local stocks could increase or the local FX could increase.
So in a world with fixed exchange rates, everything is going to be done by the local stock market moving, right? And then actually this net supply measure has to be zero or close to zero, right? In that world. In a world where you have floating exchange rates, actually exchange rates can do a pretty big chunk of the job in a sense. So then now you have a world where every single bilateral exchange rate is a function of these net supply measures, kind of scaled by particular elasticities that we directly observe, which come out of the subcomponents of our decompositions. And then in the follow-up paper, which is with Helen, we document a lot of novel facts around why does the US dollar move so strongly with the global financial cycles, but the euro doesn't, right? So there, what we're doing is tracing why does a particular exchange rate moves in response to the global financial cycle, which we measure using this US macro news that I mentioned in risk aversion shocks. Also in that paper, we showed that the global financial cycle, which usually is measured as the first principal component of risky assets, right? So that's kind of what people usually use to calculate these risk-on measures. That's where they come from. We showed that actually can have a much more kind of exogenous measure of that. We pretty much show that this financial cycle is driven by contemporaneous and lag macro news and risk aversion shocks that originate from the US due to the structure of equity markets, right? The US funds own everything, so that's why they are very sensitive to these US shocks, right? Particularly inflows into into equity funds that get invested not just in the US, but also globally. Right? That's kind of the big change.
Okay, and so what follows from that then, if, for example, Europe ended up having the biggest equity market in the world and they were the biggest investors in the world, then you'll suddenly see a Euro global cycle.
Yeah, which clearly is not going to happen anytime soon.
That's not going to happen anytime soon.
But
what you've done is you've established kind of an exogenous factor that explains the dollar centrality here, rather than us just empirically showing it.
Can you hear me?
Yeah, sorry, my
there was a moment when you froze.
My internet is quite unstable for some reason. Just hold on a second. Let me just change my the one that I'm using. Sorry about this. I think that should work now. Yeah, I think where we were was on maybe I could start my response again to say that on the Euro thing. So what you're saying essentially is that you've established this new sort of flow factor that helps explain the US centrality. So what follows then is if Europe suddenly ended up with the biggest equity market in the world and they were the biggest investors in the world, then you'll end up with a Euro global cycle, which isn't really likely to happen. But what you've done is you've added some meat or theory to this empirical observation of US driving everything.
Indeed. And then you can use, also we have a lot of facts where we show that actually focusing on just the local net supply and the dollar is enough to account for most of the variation. So you can significantly reduce the dimensionality of the problem, etc. So it has a lot of essentially.
And just going back to that Brazil example, in terms of what takes the pressure, is it the equity market or the currency? So you could have a scenario where if the local equity market goes up a lot, then the currency doesn't need to move. I mean, basically all the pressure's gone into the equity market, which feels kind of counterintuitive, because you kind of think that, okay, if the equity market's going to go up, then FX also has to go up. But what you're almost saying is actually that doesn't have to be the case.
Yeah, so in a sense, what's missing here in fixed income. So we do need to talk about fixed income, and let me kind of close the story by telling you what needs to happen in fixed income to observe what is happening in equity markets. So if fixed income is a crucial driver, right? And again, one needs to do additional work to truly nail the causal effect, and we are going in that direction here. But if the fixed income is the main driver and something else is happening in the fixed income world, it doesn't have to be the case indeed that the exchange rate appreciates. It could be that just the local stock market essentially is appreciating in response to exogenous demand for Brazilian stocks, right? Coming from the US. Now, the fixed income world is very interesting is because it's the flip side of the equity world. So what do I mean by this? So in the currency centrality paper, what we find is that there is a very interesting sorting between how much this net supply component responds to these cycle shocks, right? Which translates into how much the exchange rate responds to these cycle shocks that we capture, correlates very strongly with the openness of the stock market. So the more open the equity market is, and the Brazilian stock market is very open, right? So most of it is held by US dollar funds of locally issued equities, the more the net supply components respond, and as a result, the exchange rate is loading on this global financial cycle, right? Now, let's think about, and of course, for the US, it's kind of the reverse. The net supply is kind of the shifting in the opposite way. The US is close to a closed market. 90% of US stocks are held by US dollar denominated equity funds. So that's kind of the closest to a closed, if you wish, equity market there is. That's another unique property. The size plus the closeness are the two very unique properties that are needed in order to make the dollar a good hedge for the global financial cycle. Actually, that's explicitly made in the paper. What about the fixed income market? It's actually quite interesting because the two main markets that exchange rates are going to clear will be the fixed income and the equity market. So the real good side, that's kind of 1 year and above frequency because we have sticky prices. So we don't have to worry about it that much. So the fixed income market is the flip side in terms of openness. So what do you mean by this? So the US equity market is very closed, but the US fixed income market is super open. Why? Because we know that in normal times, US long-term government debt appreciates in bad times and the dollar appreciates. So it's the best hedge there is. So foreigners love to hold US government debt, and actually they flood into US government debt whenever we have flight to safety episodes, right? very similar, not very similar, but a little bit similar with respect to Japan, right? So Japan is also a fairly closed stock market, right? Not as close as the US, but it's one of the more closed stock markets there is. But what about Brazil? What about Turkey, right? Emerging market economies. So when you look at their fixed market, the fixed income market, they of course have, in most cases, bigger fixed income market than equity market, right? The equity markets are not that developed. But a big fraction of this fixed income market is issued not in local currency. It's issued in dollars, it's issued in euros. Why? Because PIMCO doesn't want to hold local currency denominated fixed debt, fixed income debt, they're going to buy euro or dollar, right? So what is issued in local currency, from the fixed income market, a lot of that is actually internally held, right, by Brazilian investors, if you wish. So actually, if you just think about the fraction of the fixed income market issued in local currency, which is what matters for the exchange rate, right, at the end of the day, because we want to think about Brazilian real versus dollars, actually the fixed income market in emerging market economies is fairly closed. So it's the flip side of equity. So what the exchange rate is doing is moving in order to equilibrate the stock markets and the fixed income markets that are relatively more open. So it just so happens that in the case of Brazil, the equity market is very open, and the fixed income market, counting only fixed income issued in Brazilian currency, is closed. So it is accommodating the equity market. In the case of the US, the exchange rate is clearing the fixed income market, right? And that's why you usually have this negative co-movement between long-term government debt and stocks in the US. So everything has to hold in equilibrium, right? All the markets need to clear, and the exchange rate is entering all these markets. So again, there's way more work that needs to be done, and we need to do in terms of getting truly causal instruments in some for demand shocks, etc. But this is the picture of the world that truly kind of explains the data and maps well to the data. So fixed income markets are interesting, but what we are pushing is that actually equity markets are in some ways even more interesting, particularly when we want to study as well Brazil and effectively emerging markets and some more advanced economies as well. Another thing to keep in mind is fixed income markets, often the exchange rate risk is hedged. Right? Even if we think about euro-dollar kind of transactions, so US dollar funds buying euro bonds and the other way around. Usually it's euro funds buying, US dollar fixed income assets. So if you, for example, are putting pressure on the dollar coming from euro, right? European investors are buying essentially US dollar government bonds, but they're not doing it for carry purposes, right? They just want to hold their underlying return in dollars. Then they're going to hedge the exchange rate risk. So you're putting a upward pressure on the dollar coming from the fixed income market, but then in the derivatives market, you're putting a pressure on the dollar from the opposite direction, right?
So it ends up being neutral then, because
so
it's
it ends
currency
up
hedged
being
on
neutral,
close.
right? While with equity markets, usually there's no hedging.
It's currency
right?
unhedged, correct.
That's why the causality, it's my prior, and we do have some evidence that even if you have like really exogenous causal instruments that you construct, right, of demand shocks, which is not trivial to do, but we've done some work, and Helen has done some work in the past, actually it's going to go through equity markets. And also, we do have another paper studying the universe of FX derivatives transactions in the UK. We were the first to clean that massive data set. And indeed, it is the case. That's what we find. Fixed income funds are the ones hedging and not equity funds, right? And when you go also to pension funds, there's massive hedging, right? They are truly hedging the FX risk. And that's
great.
Loaded on fixed income. So that's why equity markets are more interesting, in my opinion, when we study FX, because that's where exogenous demand shocks are not hedged and are putting the pressure on the FX.
And then importantly, you've come up with this global framework to look at flows in a clever way to work to see the transmission mechanism from equities flows to FX, which is very, very clever. And then equally on the risk premium side, the way you've looked at macro expectations and surprises by looking at lagged versions of those variables, also shows, at least in sample, that it tends to work quite well. So this is all fantastic work, and I think all of it, as you say, can be applied for investors if people think about it more carefully, and hopefully at some point you'll be able to reveal some of your secret sauce to us all. But before we sort of round off, I do like to ask my guests something on just more on the non-academic side. One is we do have some young people listening to the podcast as well. Many of them are at university at the moment, and many of them will graduate this year or have graduated recently. What advice would you give to youngsters as they enter the post-university world? Or maybe they should stay in university and do PhDs.
That's a challenging question in an AI world. In a sense, to be honest, what I'm hearing a lot is, I don't need to hire research assistants. I don't need to hire, junior. So, I mean, again, that I don't want to scare the young viewers. I think one way to differentiate themselves and to kind of have a successful career, because I do believe it's going to get more challenging to get the nice jobs where you get to work with someone more senior, where you can learn and be trained, etc. The business model will have to change. So they clearly have to become experts on how to utilize AI in their work. But what I tell my MBA students and masters in management students that are kind of the younger group is that for you to use AI effectively, you need to be already an expert in something, right? So in a sense, if you go to ChatGPT and ask a question, to the extent that the answer can be useful and, can add value to your work, you need to understand what on earth actually is ChatGPT talking about, right? The more interesting discussions with ChatGPT are the higher level discussions. So in a sense, clearly, your viewers are kind of the more driven and already, they don't need to be motivated in this way. But the way I would advise them is to learn from academia, which is, again, the word I come from, how they can exploit the knowledge in academia and bring it into finance in particular, right? In that dimension. I think that in academia, there's 20 to 30% of the work that's very exciting. Not everything is very exciting. I'm not going to lie, right? Academia has its problems and there's a lot of inertia, but there is 20 to 30% of the research that I would say is very exciting. The most exciting research is big data. But big data, what I mean by big data in finance and economics, is essentially taking a theoretical model, like what I did here is simple accounting identity that is coming out of theoretical models, but then going truly to an Einstein level, right? Very granular level and aggregating from the bottom up. What tends to work best is aggregating from the bottom up. So reading that kind of research. And there is a lot of exciting stuff happening now, right? So people are using not just this holdings data, but some people have merged, for example, the universe of holdings in the fixed income space, which is much, much harder because clearly you need the central banks, you need all the market makers because of OTC transactions. You can go only so far with mutual funds. So that's a very exciting area of kind of research. The propagation of news, right? Now the AI technology allows us to construct any kind of index using LLM, right? So the propagation of news, and here not narrowly restricted to macro surprises, which is, let's say, CPI realization minus expectations, but some very interesting research by some of my colleagues actually in the fixed income space is, let's see how, let's say, fixed income is prices are responding to updates in the Congressional Budget Office estimates of the cost to the budget of whatever congressional proposal there is. So we can now, with the ability to scrape data easily, and what I mean is now even young viewers can take advantage of that. Like back in the day, I had to hire a research assistant to write the Python scraping code for me to use it, right? Instead of me spending, months writing that code. Now I can do that with ChatGPT in half a day, right? Which is what I mean that people don't end up hiring research assistants as a result. But also that opens the possibility to your viewers to go and experiment, right? Even if they're not experts on Python coding, I would advise them to invest in learning the theory. In particular in finance, what's the frontiers intermediation-based asset pricing theories? And they're going to find what are the relevant sources there, etc. So there's a lot of exciting developments there. But if you know the theory, then with ChatGPT that is going to help you implement that theory in Python, you have much more power than someone that has just studied coding and they don't understand how to think about financial markets. So they should invest in understanding the frontier thinking about what drives asset pricing. I think that's the most valuable thing. The coding skills, yes, you need to still clearly have coding experience. Otherwise, even with ChatGPT, you can't use it in a useful way. But you don't need to have PhD in computer science, right, to be able to do incredibly meaningful big data kind of analysis in terms of, and it's going to be about big data, right?
Yeah.
So now the way I think about it, anything that is in a textual format can be scraped. So any if you think about discretionary trading, so we know that in equity already it's about 30% is systematic, right? Fixed income is less than that. So in equity, the systematic to fundamental based kind of, you go download the balance sheet and read it is kind of what I think about fundamental based research. Systematic is going to keep growing because whatever the fundamental analysts are doing, you can now automate it, right? You can now automate a lot of that analysis. So systematic is going to keep growing in importance. So being able to do big data, being able to think about what is the right model, how do you implement it, that is going to be crucial going forward. Actually, my naive forecast, who knows whether I'm right or not, but in 10 to 15 years, especially in the equity space, it's going to be mostly systematic plus index funds. Of course, ETFs, and ETFs can be on systematic as well strategies. But even with systematic, there'll be an overlay always of discretionary, right? How much weight do I put across systematic strategies based on the signal? So I think that's where we're headed. So not knowing big data, not knowing proper theory and how to exploit it, because with big data, you can also introduce a lot of noise if you don't know what you're doing, right? Yeah. So it is important to start with the theory, the frontier theory, and then bring the data and...
No, that's great advice. And then also I wanted to ask about books. You know, are there some books that really influenced you, or perhaps some books recently that you've liked?
I'm embarrassed to say that I am one of those academics that reads mostly papers. Academic. I think my dream is one day I'll go on vacation and I read a book. But unfortunately, the time constraints at the moment on my life are such that I don't have the luxury of...
Okay, no worries. And finally, I just wanted to ask you, what's the best way for people to reach out to you or follow your work, see your work?
So my website has essentially a lot of the papers that we discussed. And also there I have my CV that is listing my Gmail as well. So just...
Okay, great.
I forgot my last...
I'll include a link to that on the show notes as well.
Also, I'm on LinkedIn and I'm easy to find.
Great. No, that's excellent. So with that, thanks a lot for this fantastic discussion, and good luck with all the work, and especially good luck to the work that you're doing on applying it to investment strategies directly. I'm quite intrigued to see how that goes.
Great.
Once again, thanks a lot for all of this discussion.
Thank you so much for having me. It's a pleasure. Thank you.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.